Welcome back to Palisade Radio. I'm your host, Tom Bodrovics, and it's a pleasure to have Michael Oliver back on the show today from Momentum Structural Analysis, or olivermsa.com. He has 45 years in the financial services industry, and he's an absolute wealth of knowledge when it comes to everything in the markets. How are you today, Michael?
I'm doing just fine, Tom. How are you?
I'm great. Michael, one thing I didn't catch in our first interview was you're the author of what's called the New Libertarianism, Anarcho-Capitalism. I was wondering if you could start by telling us a little bit about your thesis that was written in 1972 and then more recently published.
The book was written when I was for a master's degree. It was a thesis, and we made a few changes in it. It was just edited by my son when we released it in 2013. The book is philosophical. It's not dealing with any current issues at that time or even in any time. It dealt with basic concepts. And it was a marriage of two intellectuals. One was Ayn Rand, who influenced me greatly during my high school and college years. And another one was Dr. Murray Rothbard, who was close to Rand at one time. In fact, he was in her inner circle of friends, along with Alan Greenspan, for example, and later rejected by Rand. But Rothbard was the prime student of von Mises, Ludwig von Mises, the father of the Austrian School of Economics. And Rothbard diverged from Rand and from von Mises in that rather than limited government, he made the case for a stateless society where market forces, voluntary transactions prevail, as opposed to top-down regulation. And Rand was, of course, a limited government, basically what you would call a conservative. She admired the founding fathers very much and their ideas. And so I dealt with those two issues. And I argued that what one should do philosophically, building from basic concepts on up to politics, which is a lesser concept, actually, is that Rand was correct on all the basic philosophical issues, but she erred in politics and therefore in economics, and that Rothbard's libertarian views in economics and politics should be supplanted on top of Ayn Rand's philosophy, and that the system then made sense. Her philosophy was called objectivism. So that's what the book does in a couple hundred pages. And again, it's very dry. It's a boring read. But I think it was well written, and I decided to publish it. And fortunately, the Mises Institute, Ludwig von Mises Institute, reviewed the book and liked it much, called it a remarkable contribution to libertarian thought. And I felt very happy with that. But that was back before I got into the financial markets. I was headed toward a career as a political philosophy professor. And I quit in the middle of my PhD work. This is 1974. We're in a global recession then, stagflation, which is coming back now. And I decided that wasn't a career for me, that I was unlikely I would get jobs anyway because of the nature of my background, intellectual background. Most universities didn't want to hire a libertarian. Pretty much had to be Marxist or some variation thereof. And so I said, no, I'm not going to do this. And a friend of mine had joined Merrill Lynch in the commodity division and said, come on in, the water's fine. And that was the time gold had been legalized in January of 1975, by the way, by libertarian lobbyists. The committee to legalize gold out of New Orleans was a libertarian organization, and they sneaked it through Congress, so to speak, got enough votes by lobbying that it actually passed and it was legalized. And of course, I had a love for gold because gold is rational money. It's not manipulated by the state. You can't inflate it and so forth. So in effect, it's a free man's money. And so I was intellectually very attracted to getting into the futures market at that time when gold was legalized. And fortunately, I got hired by E.F. Hutton National Headquarters in New York, the commodity division. And the head of that department was David Johnston, who was also chairman of the COMEX. So I got to apprentice under him. I stayed there for about a year and a half, but I got around things I never had been around before, namely the markets, trading pits, things of that sort. And I learned a lot. Then I evolved out and became a futures broker. And I worked for E.F. Hutton and Beige, a few other companies over the next 10 years or so. In 1992, I established MSA, Momentum Structural Analysis, partly because I had been solicited by a major bank that had been headquartered in North Carolina at that time, that had heard about my work and called me over for a little meeting. And I met with the head of their trust department and head of their bond department. And he said, have you ever heard of soft dollar? And I said, no. He said, well, soft dollars, a trust department generates commissions, or a fund generates commissions through trading. And the broker dealer that they trade through can use some of those commissions to pay for research for that customer, in this case for that bank. And so I got into the business of selling the research. And I got out of the futures brokerage side, which is a good idea because I don't think it exists anymore. Futures do, but I don't know how people make money. There's no more commissions. Anyway, so MSA started, but primarily our clients were institutional, banks, hedge funds, mutual funds, and so forth. But 2014, we opened up to the wide audience of individual investors and have since grown quite a bit. We look at all major asset categories, debt, foreign exchange, stocks, and commodities. And we look especially for changes in trend that look significant, not just, what's going to happen the next 2 weeks, but what's going to happen for the next several quarters or a couple of years. And so we're looking generally at longer term technical factors. And our technical tools are our own invention. They're momentum, but they're not commonly known or used momentum tools. We don't use anything that's out there on your quote screen, for example, like RSI or MACD, things like that.
Before we get to your technicals, like the way that you use those momentum indicators, Michael, I just wanted to give some color on your perspective by asking you about the book.
Sure.
Before the call, we were talking about how Powell is absolutely full throttle. And let's get some of your thoughts on how this next leg of the quote unquote, funny word to use at this moment, but recovery is happening and how much debt the U.S. can actually sustain right now.
Well, we never allow at MSA, our macro fundamental view, let's call it, to get much into our work. We're strictly technical, so we flip-flop. We were bullish on stocks in 2009. 1 week, the low week, we got bullish, major bullish. We called the top in 2000, so forth and so on. So we are flexible. We're not always bearish, we're always bullish, including with gold. We got very bearish in 2012, stayed bearish until 2016 when gold collapsed from just below 1900 on down to 1050. And 54 was the low, I think. We got bullish at 1140. So we do flip-flop. So we don't allow our long-term intellectual view get involved in our analysis. But I do think right now they fit together quite well. And I see a situation now that we're facing that is not time-bound to an event like the virus. That's an excuse. It could have been something else that pricked the wound that was below the surface. But basically, since Lyndon Johnson, the U.S. government has really been headed in a uniform way, almost regardless of which party is in power over which 8-year period or whatever, toward more and more statism in more and more arenas. And yes, it's a soft statism, loving statism, meaning they control you, but they love you. And so they tax you to death and they regulate you to death and they control more and more, all out of love for man, supposedly. Well, this evolution has been going on, again, regardless of the party. And it's gotten more and more toward full state socialism, though we don't define it that way, but that's the case. And that has been accompanied by central banks being fully in line with that direction. For instance, I think it was 2003, Bernanke wrote a paper before he became head of the Fed a couple years before, defining why the Fed shouldn't just be focused on such issues as interest rates, but should be focused on stimulating the stock market. And of course, he got his chance in 2009. He actually started before then. He started during the collapse, and it didn't stop the collapse, 2007 and 8. But in 2009, the market turned, and boy, he had his foot on the pedal. At least we thought it was fully on the pedal. We now know what fully on the pedal really means. We have power. But that created a decade of what he desired in his paper, and that was that by supporting the stock market, you cause people not to be concerned about saving and be more concerned about spending, being consumers, and therefore stimulating prices and stimulating, quote, incomes and so forth and so on. He thought it was a good thing to effectively distort the desire to save by keeping rates low and so forth. Well, they succeeded, and they drove the stock market off the page, and it's still off the page. And now Powell's got the throttle all the way to the floor, even more than we thought it was possible. That has accompanied the rise in the federal government's powers. And so the two have worked together. And now I think we're headed for the giant swirly, where if these ideas were valid, we had to remember the war on poverty. We also had the war on drugs, neither of which has produced success at all. We have a crisis coming based upon the distortions that have been built into the political and the economic system over those decades, but especially since 2009, where the central bank aspect has really gotten very exaggerated. So now if there were errors created there in people's perceptions, people's spending patterns, people's non-saving patterns, companies' non-saving patterns, we've created a huge debt bubble. It could be defined in many different ways on micro and macro levels. And if that ever comes unwound, then the errors will be exposed like a giant wound being opened. And like when you get sick, you want to regurgitate. That's what effectively is going on, we think now. We think that the virus helped prick it, but it exposed things that were already there. As an example, speculate on this. What if the average middle class or even less income folks had a savings, let's say a couple months, 6 months of savings to accommodate their basic monthly needs? And then this virus hit. Then they would have been better suited to handle the crisis of being unemployed for several months or not being able to pay rent. They would have had the money in the bank. No, not a lot, just enough to cover their bills. They didn't. We know this. There's the common poll that is taken that how much can your family afford in emergency money? Can you afford a $400 emergency payment? And that really has not changed or bettered since 2009. And it's because we don't save. And that's the policy effect of the central bank. This, I think, could cause a crisis in many different ways, again, on a micro and a macro level, more ways than you can define. And so if this giant swirly occurs, which we think is now in the process of occurring, it will have market effects. It will have social effects, as you see in the streets of some cities now. And we think that probably it won't occur incrementally. The process itself has been incremental since 1970s in terms of the growth of the state and so forth. When it comes unraveled, we think it could come unraveled literally in months or a year. So we think 2021 is likely to be probably the near complete full unraveling of the errors beneath the surface and the social and political consequences thereof. And I think it has very little to do with who selected president or who was president over the last 4 years. This process was underway. It has not been changed. And Trump, despite his claims of being conservative and wanting to limit government in various areas, which he's done. In other areas, he's gone full throttle to modern monetary theory. Because if you recall, a year or two ago, he was pounding on Powell to cut rates to zero or lower. Let's compete with the Europeans, he said. If they're at zero, let's go negative. And he also encouraged him to print. Well, that's hardly a policy that you would think of from a, quote, conservative GOP president, right? I assert he really isn't conservative. He's just more in line with the trend we've been in since LBJ, at least. And therefore, he has helped facilitate the swirly coming on, and the virus helped do that, which is, of course, his excuse. But I think ultimately people will see beyond that. But anyway, I think we're headed for chaos theory now, that where things don't occur incrementally, they occur rapidly. And we'll see this in the marketplace, in all of them.
So as we speak about, Michael, the upcoming unraveling in 2021, and also Bernanke's goal of creating monetary velocity by blowing up the stock market instead of encouraging saving, you were able to, in 1987, identify, anticipate, and catch the crash. So what are the red flags in your analysis showing today, and how long have they been up? And maybe we can use the NASDAQ and the S&P as examples.
Well, the 87 crash is what was 87, 5 years before I set up MSA. I caught the crash because of quarterly momentum. Now, what does that mean? It means you take the monthly price chart of the S&P and you overlay a moving average on it, three-quarter average. Now, I don't care about that chart. What I care about is the chart that does something else, and that's our momentum chart. What we do is then oscillate, plot on a chart, each monthly price range in its relationship to above or below the current three-quarter moving average. And you get a totally different chart picture when you oscillate price versus the moving average rather than simply overlay price on the price chart. And that oscillator had a floor. You looked at the price chart, you saw an uptrend. You couldn't even define a very good uptrend line on it. So the price chart really wasn't much help in protecting you in terms of where do I have my risk control. But the momentum chart developed a flat floor for several years. Come down to the three-quarter average, turn up. Come down to the three-quarter average, turn up. It built a flat floor. When you looked at the momentum chart, you could see a vulnerable structure underneath your feet. And so about 2 weeks before the crash occurred, the price action in the new quarter, which is the fourth quarter of 1987, the three-quarter average had jumped up because it was a new quarter, adjusted up in October, early in October. It broke through that momentum floor. And 2 weeks later, all hell broke loose. We had a crash event, a 35% or so drop. You had the same thing when we went back in time in 1929. It was almost a direct overlay of the quarterly momentum of what happened in 29. Now, the outcomes in both cases ultimately differed. In 87, it turned back up and stayed up. In 29, it rallied and then failed for a couple of years. And there were reasons for that were based on annual momentum. Don't want to get too complex here. But what we had with our MSA tool of momentum structural analysis is a different chart than the price chart most people look at when they think of technical analysis. Well, we could see a same crash event coming up last summer. I had some interviews with some shows and dealt with this issue of the pending crash in the U.S. stock market. And it was the same chart, except it was on annual momentum instead of quarterly momentum. In other words, there was a big flat floor that went all the way back to 2009, 2010. And every time we had a sell-off in the process of the bull market that we've been in, it would stop near the zero line, near the 36-month average, and turn up again. And so while price was in this upward curvature, momentum was not. It was living on this flat floor on momentum. And we knew when we broke that, it wouldn't go down gently because the structure was too big. It was too impressive. It was too clear. It's like the bridge on the River Kwai. If you blow out a couple of the pillars underneath it, the bridge will collapse. And we could tell that would be the tone of the market if and when we broke that structure. We broke the structure in early February, and we crashed. Now, the difference is this time there was a story that went along with it, whereas in 87 and 29, there was not really a news story that sort of led you in the false direction of why it occurred. You only found out later. But in our case, we had the story of the virus. And so a lot of people thought, the smart, quote, contrarian traders who are still playing the game, that, oh, well, this is just a temporary thing. It would never have happened had this not occurred. Therefore, I'm going to buy it because I know the virus is going to go by the way at some point, and it'll all be gone and we'll be back on the course again. Well, we argue that no, yes, that was the excuse for the break, and therefore a contrarian's excuse to buy the market, which is going on, but not really the underlying problem. And when we look at the various stock indices around the world, developed markets we're talking now, not the emerging, but look at Japan, we look at Europe, and we look at various U.S. indexes, not just the NASDAQ 100, which of course is stellar. We see a broken picture. We don't see one that's healthy. We see a rally that is likely to fail and go back into the sewer. And I suspect our work suggests, and we don't have the triggers yet, that probably in September we'll start down again. And at that point, the rally will be over. Now, this time, instead of like 29 or 87, we did go to new highs this time, unlike in 29 or months after the 87 crash. This time, I think we'll roll over again and go into a slow, excruciating bear market, likely one that will be quite deep and damage many portfolios. And that's the one thing that's out there right now that Kudlow talks about. The people's 401ks are doing great. Well, basically, yes, that's true. But it wouldn't take much for those 401ks to suddenly not go great, in which case they have nothing in their portfolios that looks good right now. And I think that's the vulnerability that the stock market will expose, probably beginning from high in September.
So let's turn a little bit, Michael, to a broader index that you have identified that is looking very promising. So let's talk a little bit about the Bloomberg Commodity Index, or the broader commodity complex as a whole, and how many different pieces of that puzzle are all pointing very positively.
The S&P and the Bloomberg Commodity Index both made highs in 2011 and pulled back. You remember the European debt crisis, where the S&P had a pretty good sell-off. Well, at that point also, the emerging markets and the commodity markets peaked. Now, at that point in 2011, that's also when gold was up above 1900. It peaked there, too. All those markets dropped at the same time for the next 6 months into late 2011. And it was only the stock market that turned back up. Again, the Fed had the back of the market, and the market was still cheap then in terms of historical prices, talking the S&P now. But the commodities didn't. They continued down through 2015, 2016, where most commodities bottomed at that point. Put it this way, didn't say bottom. They made a low, and they stayed off that low for several years. They had a rally into 2016 and 17 and 18, but it didn't really go very far. It just kept them off the lows. And it's pretty much across the board, whether you're looking at grains or oil or soft commodities, including gold. And they rolled back over again into 2018. And now the Bloomberg actually made lower lows in March of this year than it had in 2015 and 16. So did quite a few commodities like oil. Copper did not. It came back and tested its lows. The grains basically went back to their lows, had a flat sideways action since late 2015. But basically, commodities have not participated as a group in any upside that the stock market has seen since 2015-16. That was when the S&P made a secondary low. They didn't participate in that. So they just laid on their back for all those years and demonstrated effectively that they just can't collapse anymore. No, they didn't go up, but they can't collapse. They're deflated totally. But unlike some stocks that could go to zero, commodities can't go to zero. But during that time, the technicals of the Bloomberg Commodity Index, of the grains, various key markets within the commodity complex developed, from our work, major momentum bottoms. And right now it happens that the Bloomberg Commodity Index is literally decimals away from levels that we think if it closes out the month, this month or next, at those levels, that it is saying, okay, it's all over, we're now a bull market. And then you look at a price chart, you won't see this. But when you look at the momentum charts, long-term momentum, you can see that there's a major breakout pending. And that we're right at the levels right now, at the starting gate, as it were. Now, we know that Powell wants to encourage inflation because he doesn't think it's out there. I guess he doesn't look at an S&P chart and see that as inflation. He's looking at the Bloomberg. Well, you're right. If you look at the Bloomberg Commodity Index, which is a fairly well-balanced commodity index, by the way, it's not overly weighted in the energy sector, for example. It's going to give him what he wants, but it's going to give it to him in doubles and triples of what he wants. And it's probably going to do it rapidly. Now, this is like the late 70s again in certain respects. One, we had weak economy around the world, 74, 75. And stocks went into a wasteland until 1982, where if you've invested in the S&P 500, you made some money a few times, you lost money, but basically it was a sideways desert from 1976 to about 1982, where you didn't make any money. But commodities exploded, but they were led by gold. Gold was on the upside from a low in 1976, down near 100. It had turned up, and a couple of years later, the Bloomberg, or back then the CRB index turned up and joined gold, leaving the stock market as a wasteland. And we think that's where we are again. That the place to be, if you want to invest, you want to put money into your portfolio into something that's low risk, likely high reward. We think it's commodity and commodity related stocks. Commodities themselves are commodity related stocks like energy stocks, grain related stocks, and so forth, copper producers. We think that's where the best money is going to be made over the next several years, in part because one, it's depressed and proven it's not going lower. And two, we now have a central bank that's going to print it higher. Not that that's really where they want to see go up, but that's what they're going to get. And we think gold is warned of that. So we have a very similar picture to the late 70s, but this time I think it's different in that I think the crisis effect in many arenas is so strong this time that it will not be just shrugged off with the commodity boom and so forth. They will have dislocation in many areas. But during that time, that will be a good place to be. And we think it's about the start for the broad commodity complex.
So as you were saying about gold kind of signifying that real acceleration in the commodities, can we talk a little bit about the TLT and the breakout that you've identified and what that also signifies?
Well, we look mostly at the T-bond futures, 30 years. Now, the TLT is 20-year plus debt ETF, so it's fairly well connected to what the T-bond futures are doing. But that end of the market, the longer-term end, the central bank has less direct control than it does over the short-term end. So that's why we like to look at that end, because we know that though a lot of people think the Fed controls rates, they don't really control the long end that well. And if the long end wants to go in a different direction, such as higher rates, it can do it, despite what the central bank might want to have happen. And we suspect with the commodity boom, at some point down the road, probably by next year, we're going to see T-bond prices dropping pretty sharply and yields going back up, despite Fed policy the other way, because they don't control that end. And we're also looking at the bunds, the German bonds, and the JGBs, Japanese government bonds. We're watching all three of those for a sign of downturn in price, upturn in yields. But we don't think it's right now. T-bonds are under pressure for the last week or two. But if you stand back and look at TLT or the T-bond futures going back to, let's say, March, and eliminate some downside spikes and some upside spikes, you'll see basically a horizontal price action. And during that time, while the stock market has roared, this alternative to the stock market, which is the way many investors see the bond market as a safe alternative, has not really collapsed. Why not? Why have not prices of government debt collapsed as people feel more comfortable to be back in stocks and therefore don't need to buy fear assets? because apparently some people aren't convinced about the stock market and they're still buying the bonds. We think the current little drop is minor. I don't think it's going to get traction. There are levels that we could see in the fourth quarter of this year that if T-bonds got down below them, it could cause breakage of some significance. But we don't think that's going to happen. We think we're going to hold, and probably between now and the end of the year, in a renewed downdraft in the stock market, we'll see T-bonds firm yet again. Yields drop more. Now, after that, let's get into 2021. I think that's when you've got to relook at the bond market with a totally different view, not as an alternative to stocks, a safe alternative, but possibly as a coincident trending indicator, meaning bonds go down with stocks, which is just what stocks don't want. They don't want higher yields. So if bonds do top and go down, it's not going to be a good sign for the stock market. And it's also going to eliminate the alternative of the government bonds. It's going to leave you with basically one other alternative, and that's gold and commodities as uptrending assets. So, but right now, TLT, I think the downside we're seeing in price is probably not sustainable. It's probably not the beginning of a real down. We suspect that's reserved for some months from now.
So back in February 2016, Michael, you were able to really issue basically a buy signal in gold at 1140. Can you tell us a little bit about what types of factors that you used to identify that buy signal, not necessarily the bottom, but a buy signal to become bullish again?
Well, actually, we thought it was the bottom. In fact, it was. The low that had occurred before that was at 1054 price level, very briefly in late 2015, as I recall. But in February, early February, we had enough upticks to cause not a price breakout, because if you look at the price chart, you don't see any structure you're breaking through. It just was another rally. There were many rallies in that bear market, which were all false. And we generally were not deceived by any of them. Again, we got bearish in the mid-1600s in 2012, early 2012, and stayed bearish through 2012 into early 2013. And then finally, our bearish bet paid off. The gold market crashed. And it continued down through 2015. But that upturn in February 2016 broke through a very obvious annual momentum ceiling that gold had established in the prior couple of years. Now, you didn't see that ceiling when you looked at the price charts, but when you looked at our annual momentum, a blind man could have seen it. And so in February, we blew through it. And what happened? You went from 1140 up into the mid-1300s in a heartbeat. So that was gold's first exhale. It was his first statement. It says, I'm through. Okay. Now, admittedly, it did pull back again. 2018 got down into about the mid-1160s, almost back to where we'd gotten bullish before. But that break didn't make us bearish. It was just a pullback within a basing process. And then, of course, even the price folks got their breakout in last summer when all the rally highs that tended to peak in the mid-1300s were blown out. And so a couple $100 higher than where our initial buy signal occurred at 1140. Several years later, price gave its breakout signal, and we've had the consequent action since. So, but it was a very clear momentum structural breakout. That's what caused us to shift from bearish to bullish. Right now, if we reverse that logic, we ask ourselves, is there a structure below that could cause gold to break down on a sustainable basis, looking at our quarterly momentum or annual momentum? The answer is no. There is no evident structure. And usually when there's not something to break out above or break below on long-term momentum, don't expect a move in that direction. So right now, we don't expect any sustainable downside in gold. Sharp dips here and there, yes, that's been the modus operandi the last couple of years, yet still massive gains. And we think the game has only really just begun.
And to really illustrate exactly what you just said, the game has just begun. In your last newsletter, you were saying that we are going to perhaps see the most dramatic move gold will ever produce in our lifetimes. So obviously we have so many different factors as a tailwind for gold that you're saying that we could see the most dramatic move in basically a bull market for gold, correct?
I think we'll see probably the last, at least for my lifetime, perhaps younger folks, bull market in gold, because I think the resolution fundamentally of the next major market crisis, and that means the up in gold, down in equities, and likely down ultimately in bonds as well, bond prices now, that chaos and the wave effects of that will cause fundamental changes in monetary policy, perhaps even the abolition in some places of monetary policy, meaning central banks will no longer dictate monetary policy. Market forces will determine what interest rates are rather than government edicts. There'll be a rethink at some point because people will realize, or at least some will, perhaps with enough political influence to affect change, that, hey, you know what, this didn't work since the 1970s, the full fiatization of the developed market currencies. It didn't work. And somebody will rethink it, and already the Chinese are in this direction of a gold-backed currency and the stability that goes with that. And so I'm not sure where gold's going to go. I don't know if it's going to 10,000, 100,000. I don't think what you should do is look at gold only from this point forward. It's not just in a normal bull market like it had, in 1975, or it had in 1980, or it had in 2011. This is going to be different because it's going to have wave effects in other markets that will be impacting gold itself and vice versa. So I think if you're long gold, you shouldn't be looking at the day-to-day swings or week-to-week even. You should be looking at things like right now, for example, why would the Bloomberg Commodity Index, the commodity asset category, break out to the upside if gold were about to make a top? Why would commodities be about to state we have inflation again if gold were about to make a top? So people in the gold market should be paying a lot more attention to other markets out of their side mirrors instead of just their front windshield. And I think the Bloomberg is about to now endorse, in effect, what gold has already been saying. And other markets in inverse ways will be endorsing gold. At some point, I think the bond market will top, as I said, that'll be endorsing gold, higher rates. Stock market will again be in trouble, endorsing gold as a safe asset. So anyway, I think you should be looking wide. And right now, I don't see the situation in gold that indicates trend vulnerability to the downside on any sustainable basis.
So as we're saying to look wide, Michael, let's talk a little bit about silver. And we're seeing that it hasn't broken out above its all-time high, whether that's inflation adjusted or not. So tell us a little bit about the possible upside that you see for silver that are coming.
Of all the commodities out there, I'd have to say silver's top of the list. And it became top of the list, and we anticipated that it would become at the top of our list. Even though silver's acted like a dog from the 2015-16 low, when it was down to the $13 area, it rallied up to about 21. That's when gold went from under 1,100 up to 1,360. Okay, silver had a huge move, nice big percent move. It outperformed gold during that first rally. But then after that, gold didn't go back to its lows, but silver did. In fact, in March of this year, it punched out that low, got down in the high 11s. So like the Bloomberg Commodity Index, it pricked out its prior low of 2015 and 16 by just enough to spook everybody out of that market. And we thought there might be a rubber band type snap at that point. Sure enough, there was. We called it a bear trap, both for the gold miners and the silver market then. In other words, the sell-off would trap bears and also run a lot of bulls out of the market, therefore cleanse those markets. And sure enough, the upturn we got in silver and the gold miners at that point vastly outstripped the upturn in gold. And recently, silver did two things, technically. We analyzed its annual momentum, and there were two rallies over the last several years, one of which peaked, like I said, at 21. This is, I think, one was at 21 and one was at 19. The $19 plus high came last year. Okay, so the two rally highs weren't connected. They were a couple dollars apart. But when you looked at our annual momentum chart of silver, they were at exactly the same level above the 36-month average, meaning one was at 19.4% over and the other one last summer was at 19.4% over the 36-month average. And then we backed up into March of this year. And when we came roaring back up in July and traded 1948, which again didn't take out any price highs, but it caused momentum to hit 20% over the 36-month average. Pardon me for being technical here. But when we took out those two dual highs that you could see on a momentum chart, but not on a price chart, we had a triple top breakout by annual momentum of silver. We argued that if we hit 19.48, that silver would likely launch toward 30 rapidly, just as a first response, not as the ultimate swing objective or anything of the sort. So what did it do? It ran up to 29.90 or something. And now it's congesting violently in the upper 20s. But it's a matter of 2 months. You were trading in the upper teens, and now you're trading in the upper 20s. We think this trading around in silver right now is no way it's topping. It's just violent congestion. And likely we're going to take out the all-time highs in silver, in which case $50 is not going to be a double top. It's going to be a triple top breakout for the price chart folks. Now, where might silver go after that? I'm not sure. It's just like gold. I'm not sure. Something dramatic, $100, $200, I'm not sure. But we think silver is now shifted from an underperformer to gold to technically, we've measured it in terms of performance readings, percentage comparisons of price gains and losses over time. Silver's broken out of its relative performance charts to the upside. It's now an outperformer to gold, and we expect it to remain one for the next couple of years. So if you're going to be in the gold market and related, we suggest be in the silver market. Watch gold, but be in silver.
So, Michael, in your opinion, is there any space in your investing allocation for any of the miners?
Oh, yes. We think the gold miners are also in that category. They underperformed from that 2016 initial rally high when gold, silver, and gold miners all ran up from early 2016 to July of 2016. After that, they underperformed gold again, but they've now shifted their relative performance to gold to where they are now outperformed. Now, we think we would rank it this way at the present. Silver on the top, silver miners under the mining category beat gold miners. Gold miners next, and then gold in that sequence. Now, gold is still the mama, so we have to watch gold, even though that may not be the best performing situation in terms of upside gains. But we think that's the preference scale right now. It's silver miners, gold miners, and then gold, all as a package.
Excellent, Michael. Is there any thoughts you'd like to share with us as we wrap up? No,
I think that if you're an investor, there are various vehicles now. You don't have to be in the futures markets to participate in commodity upturn. I would have to say the commodity category is right now probably the lowest risk, highest reward place to be and to initiate positions now. We're not calling something after the fact. We have specific numbers that are in our reports. The Bloomberg Commodity Index has two breakout levels above it, one of which we're playing with right now, the other which is not far above in the next few months. That when engaged, they will create the greatest percent upside in a short period of time of any category out there. They might even beat gold briefly, although ultimately we think that silver will outperform the commodity category and gold will too. But the commodity category has been so deflated for so long that it's like a submerged beach ball. When you let go of it, it just goes whoosh. And I think it's about to let go. And there are ETFs that trade commodity futures like the soybean ETF, corn. Now, a lot of these are not very liquid. I'll have to admit that. So you have to be careful about that in terms of, how much volume are you introducing into that ETF in terms of your capability to buy how many hundreds of contracts. But they're viable. They've been around a while. There's also broad ETFs for the Bloomberg Commodity Index. You can go on Google and look them up yourself, and I'm not going to recommend one. But reference the volume, the average daily volume you see connected to that ETF. So there are ways. Also, some of the, for instance, in the oil sector, a lot of the oil sectors, for instance, the oil services sector and exploration, not just the XLE, which is the general ETF of the oil sector, but some of the lesser subsectors look to us to be basically those same type of submerged beach balls. And therefore the percentage potential gain they can produce over a short period of time versus the potential risk, we think that risk is now depleted totally, could be very substantial on a percentage basis. And so we'd be looking there. So commodity-related stocks and the broad commodity complex, we think right now is probably the best place to be looking for a new investment arena.
Excellent, Michael. And just a reminder that anybody can sign up for your newsletters at olivermsa.com, correct?
Correct.
Perfect. Thanks for your time today, Michael.
Thank you, Tom. It's been fun.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.
Think you understand the junior mining sector and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip your face off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?